Hello, everyone. Hope you had a good weekend and are ready for some exciting Chapter 5 discussion. Speaking of Chapter 5 discussion, before we get started, I have a couple things to remind you of. First of all, on Wednesday, we will have another discussion over the topics we're going to be talking about today. If you go to Brightspace, you will notice that in week 4, it actually has the discussion item, and it has everybody's name that's in this class assigned to a particular item. Basically, what that means is whatever item you've been assigned to, you need to figure out what that item is. You need to answer these 3 questions about the item and be able to discuss them on Friday or on Wednesday. Yes.
If there are 2 people, should we do like one coherent document, or should we both do?
You don't. There's first of all, it's a discussion, so you don't need to document anything. It's just a. So you should each do it independently. Yeah. And so I will probably ask one of you to do one part and one of you to do the other part. So I would do all 3 parts for even if there's 2 people assigned. As we'll find out, there's going to be a lot of information that's going to be disclosed in this particular discussion. I recommend that you come ready to take notes on this because this is really, really important stuff that you'll be tested on. And even though we're going to go through it quickly, you're going to be responsible for basically every word that is going to be said during that discussion. So, yes.
I was looking at the study guide for the EWC questions.
Mm-hmm.
On the test, would it just be like how we did it on the homework?
It'd be mostly conceptual about what the purpose of a particular activity was. Okay. I'm glad you mentioned that, by the way, because the study guide is going to be relevant to what's happening next Wednesday, which will be exam number 1. So yeah, I know stress starts up. Study guide and practice exam are already been posted. There will also be a practice exam key available once we start class on Monday. Though you all know my story by now, is that I encourage you to complete the practice exam in advance of the class period, and so that you know what it is that you need to work on and what it is you've got down. Yeah, so that was my second announcement, is to remember the exam coming up. All right, as I alluded to on Friday, today we are going to talk about what I feel is probably the most important chapter in this course. Boy, just sprinted here from
yeah.
Okay, yeah, nice. Okay. Yeah, so I'm gonna get distracted if I don't start talking. All right, so early on in this course, I alluded to something called management assertions, and today is the day when we learn about management assertions. As we already know, management assertions are basically what underlie anything that goes into the financial statement. By putting it into the financial statement, management is making an attestation about something that's there, and we call that attestation, the context of those attestations, assertions. But what does that really mean? Some of these we've really looked about a little bit. Some of these we're going to go into more detail. So here's our list of assertions, and this is again copied straight from chapter 1, or sorry, our chapter 1 discussion. I'm going to go into each of these in detail in just a second, but there are a few things I want to allude to. First of all, whenever I say management assertions, that can be used interchangeably with audit assertions, or oftentimes I will just use the word assertions. In fact, I try to get in the habit of not using the word assertion in this course to mean anything other than what we're going to be talking about here. So that's just an important piece of information to note. Also, you'll notice the initials beside each of them. Not all assertions are applicable to every regulatory framework we're going to be talking about. In fact, that last one, we are going to talk about it as an assertion because it's in the book, but it's not really a management assertion. It's not been recognized as a management assertion for about a decade now, maybe longer. So the book just continues saying it's an assertion, we promise, and it's not. I will never test you that as an assertion. We will talk about authorization, but more as its context to controls rather than at being a management assertion. But the first 7, you definitely should know. Of the ones that you should know of the first 7 the most, you should know the first 3 the very most, because those are the ones that will come up the most frequently. So let's go ahead and talk about these and go into a little bit more detail. All right, so first of all, we've got completeness. Completeness is going to be, I probably should put in context. We're going to consider the assertion both from either from transactions and events perspective, count balance perspective, or both. All right. If you see 2 lines here, 2 bullet points, it basically means it can be considered from both perspectives. If it's only 1 bullet point, it can only be considered from 1 perspective. The difference for that being is that if we're talking about transactions and events, that is what's referring to day-to-day operations perspective. If we're talking about account balances, that's talking about information in the financial statements perspective. A lot of these assertions apply to both. what we consider with respect to both changes depending on the category of assertions. We're going to talk a little bit more about the category of assertions and which assertions belong in each category in just a second. There's an easy way to remember it, but for right now, when you see it, keep in mind that for like completeness here, there's two contexts that we can consider it from. So all transactions and events have been recorded. So everything has gone into the system, and all ending balances, the balance sheet amounts, accounts that should have been included in the financial statements have been included. So anything that should be in the system or anything that should be in the financial statements has been included in the financial statements. Completeness is a critical assertion for liabilities and expenses and equity to a lesser degree, because it's very common for organizations to try to want to record things that put them in a negative position. So we as auditors have to be concerned that anything that might put them in a negative financial position, such as a liability or an expense, gets recorded in the financial statements. All right, this is one perspective. The exact opposite of this is considered to be existence occurrence, okay? And existence occurrence says that all recorded transaction events actually occurred and pertain to the entity. All ending balances for balance sheet accounts that have been included in the financial statements actually exist, okay? When we talk about existence occurrence and we talk about completeness, they're basically the opposites of one another. Existence occurrence is saying that completeness is saying that something took place. We want to know, did it get recorded? Existence occurrence says something got recorded. Did it actually take place? So think about it. Something exists. Did it get recorded? Something recorded. Does it exist? Existence occurrence is working in the opposite direction. It wants to make sure that anything that was recorded actually occurred and pertains to the entity, and that anything that should have been included in the financial statements, they actually exist. Now, we're going to allude to this a little bit more. We consider these two assertions, completeness and existence occurrence, to be directional assertions. And the way you think about the direction is you think about kind of like a tower moving upwards. So your foundational information are going to be your source documents. Then we're going to be talking about things that go into the system, and finally the information that goes into the financial statements. And the normal operations for any accounting system is going to be moving up the tower, okay? The source documents generate the system information generates financial statements. When we think about these assertions, the direction we're moving in the tower implies the assertion. So remember, I said that completeness says something exists. Did it get recorded? That is a bottom to top assertion, okay? We start at the bottom with the source documents and we move up to see what's been recorded. Existence is just the opposite. We know something was recorded, something is in the system or it's in the financial statements. We start with one of those two and move down. Can we find evidence, source, that those transactions or that information actually exists? So that's moving top to bottom. Direction is really, really important to remember for that. The good news is I'll teach you a really quick way to think about that, because we actually had two specific tests that apply direction here in just a little bit. But let's move on to the third of our most important ones. This one's a little bit easier to digest. This is valuation, allocation, and accuracy. By the way, so I do tend to use shorthand or vernacular. So in the book, you will oftentimes see like existence occurrence. They will refer to existence or occurrence, sometimes not both. Whenever I refer to it in this course, I'll usually use both. For valuation, allocation, accuracy, the same thing. They'll use one of those three terms, but it means the same thing. I will usually call it VAA, just for shorthand. All amounts related to transactions events have been recorded appropriately. All ending balances, balance sheet accounts have been included in the financial statements and been recorded their appropriate amounts. So it's an important distinction to make. When we talked about completeness, we were talking about, did something get recorded, period. If it was not recorded, that's a violation of completeness. If it was recorded, then completeness is met. This is saying something was recorded. Did it get reported at the proper amount or for the proper value? So this is another recording assertion, but this is specifying that it needs to be recorded correctly at the correct amount. So there's a little bit of a distinction there. So those three are really important. Those three will occur in all of our categories of assertions. And I will say probably about 70% of the issues we'll look at will fall within one of these three assertions. It's hard to quantify because sometimes there's going to be multiple assertions present. And I will give you specific examples to try to test your knowledge of other assertions. But these three are the three most important ones to know by far. And to make sure a good knowledge of these three assertion areas will be very, very beneficial to you. Let's talk about some ones that are a little bit more specific. So now we have rights and obligations, okay? So rights and obligations says that for balance sheet accounts with ending balances recorded in the financial statements, the entity holds or controls the rights to assets controlled, included in the financial statements, or all liabilities are obligations of the entity. So we use the term rights. We're usually referring to the rights to recognize the assets in the balance sheet. We use the term obligations. It means that we have the obligation to recognize an entity in the balance sheet. You will notice here that I said ending balances, but we didn't talk about transactions and events. Rights and obligations is only relevant to one category of assertions, and that's what the account balance is. Okay. Now, the more specific assertions, we have classification. Transactions events have been recorded in the proper accounts, and ending balance have been recorded in the proper accounts. So this is another recording assertion, but this is specifying, did they get put into the correct accounts? This is a really, really critical assertion when we think about earnings management. One area of earnings management that's very common is to record items in incorrect accounts. This happens a lot when we talk about recognizing something as a current liability that should be a long-term liability because of financial statement ratio obligations. So classification is one of those things that we want to make sure that everything is recorded in its correct account. So again, a little bit of a distinction from the other recording assertions. This is saying, look at the account. Is this an appropriate account? Presentation. Presentation is very closely related to classification. It says transactions and events have been clearly presented and disclosed, and all ending balances have clearly been presented and disclosed. This is just basically saying that items are correctly included in the financial statements where they should be. Anything that's supposed to be presented or disclosed in the financial statements, or anything that's should have been presented or disclosed in the financial or the information system has done so. Now we have a bit of a special assertion, another recording assertion, but this one's a little bit unique. This is called cutoff. All transactions and events have been recorded in the correct accounting period. So for earnings management in particular, this is problematic as a lot of organizations will try to move the timing of their sales or their liability recognition to try to improve their financial status. As auditors, we're very concerned about making sure certain transactions and events are recorded in the correct period. You will notice there's no ending balance mentioned here. This is only relevant to the category of transactions and events assertions. Those are our 7 assertions. I'm going to throw up the 8th one here, which is not a real one, but authorization, recorded transaction events have been properly authorized. Okay. So those are our assertions. And if we break them down, there's multiple categories we can actually identify them for. You don't need to worry about trying to memorize everything on this table. This is just kind of showing delineation. For right now, before we get into the nitty-gritty of what the assertions represent, the easy way to think about these assertions is that all of our assertions, with the exception of rights and obligations, are relevant to transactions and events. So all 7 assertions, or 8 assertions if you want to include authorization. I don't particularly care. If you guys really like authorization and want to include it in your hearts as a true assertion, that's fine, okay? No judgment here, but it's not a real assertion. It is like the stepchild of the assertions, okay? It's been adopted. All right, so all assertions with the exception of rights and obligations are considered to be part of transactions and events. And then on the flip side, with respect to account balances, all assertions except for cutoff and authorization, if you include it, are considered to be parts of account balances. That's the easy way to remember those. All right, so what does this all represent? Well, let's just go ahead and let's do a little bit of a breakdown. And this is kind of an example of how we would tie management assertions to audit procedures. And we're going to learn about the different audit procedures here in just a little bit. But for context, we need to understand, what is the relationship here? What does this mean? So this is an audit program for accounts receivable. This is a pretty simple audit program. This basically just says we are identifying what our risk areas for concern are. And we characterize risk in auditing according to management assertions. The risk that this assertion could be violated. So we've identified the existence of accounts receivable, the rights and obligations associated with accounts receivable, completeness of accounts receivable, and valuation allocation accuracy of accounts receivable, all to be potential risk areas for this particular account. So in order to make sure that these are all correct, we are going to perform certain audit procedures. So what are we saying here when we talk about these particular assertions? With respect to existence of accounts receivable, the accounts receivable is going to be on the financial statements for a certain amount, and we need to determine the customers who owe these receivables, do they actually exist? And does that amounts that they reported are correct? Which is more evaluation concern, but we're really concerned about the existence of the receivables themselves. So let's assume that you are an auditor you're testing your client's accounts receivable and you're like saying, I've got to determine if these customers actually exist. What would be the easiest way to determine if a customer, an entity of some type existed? Yeah, call them up, contact them, okay? Contact them, which we're going to determine is going to be basically reaching out to a third party request called a confirmation, which is, we notice it'll say confirm accounts receivable, okay? We're going to get into a lot more detail about the nature of confirmations when we get to chapter 10 and start talking about revenues. But that's one of our primary tests, is to actually reach out to the third party and say, hey, are you real? And they're going to say, of course we're real. Or they're not going to reply at all, which means they may not be real at all. So one of those two. They're very rarely will you contact them and they'll say, no, we're not real. Okay. That just does not happen very often. Then we have rights and obligations. Okay. Rights and obligations. How is this relevant to accounts receivable? Well, accounts receivable is obviously an asset. It's possible that a company could factor their receivables, which factoring is just a fancy way of saying, we don't want to wait to collect those receivables. We're going to sell them to a third party who will collect on our behalf. And in doing so, they're going to give us money for those receivables, usually at a discount, but we get the money now, they get the receivables when they can collect them. If we sell our receivables and we factor those receivables, we don't have the right to collect them anymore. Okay. So we can't put it on our balance sheets as saying something that's a continuous asset. So we need to make sure that these receivables are not factored. How do we determine that? We're going to go talk to management and say, did you sell receivables? And presumably management will say, oh, yes, we did. That shouldn't be on the financial statement. Says, no, all the receivables are good. Okay. These belong to us. Completeness. Okay. We want to make sure that if any receivables took place, that they actually got recorded. Okay. This is going to be one thing where we can go to the accounts receivable subsidiary ledger and we can go to the accounts receivable control account. Okay, so when we talk about we talk about completeness, remember that's a bottom to top assertion. So we're going to look at the subsidiary ledger where the items are recorded and see, okay, did this go to the control account? It's supposed to go in the financial statements. Did this move upward and get recorded into the control accounts? And then finally, VAA. Well, VAA, I'm going to tell you right now, you will hear this multiple times throughout this course, by the way. With respect to the term allowance for doubtful accounts, whenever we use that term in auditing, by the way, do you all know what allowance for doubtful accounts is? That contra asset that offsets accounts receivable. So whenever there's a bad accounts receivable, you can write it off. Yeah, I learned about that in 303. Whenever you hear that term here in auditing, the first question an auditor will always ask with respect to the allowance for doubtful accounts is it properly valued? In other words, testing VAA for that particular item. So if you hear allowance for doubtful accounts or here bad debts expense or something along those associated items, you should automatically think, okay, we're thinking VAA. I have actually been teaching this course. This is the 9th year I've taught this course. I cannot think of an instance where allowance for doubtful accounts has come up and it's not been related to valuation allocation accuracy, because that's a big concern in this area. All right. We're going to come back to these audit evidence, types of audit evidence, because these all represent individual types of audit evidence that we can actually perform. But let's talk about some concepts related to audit evidence that we need to be aware of. So concepts for audit evidence. So before we actually get into the types of audit evidence that are available, we want to understand, what is audit evidence intending to do? Now, this is really important because this will come up a lot. And this happens a lot in this chapter, by the way, is that when I say audit evidence, I may say audit testing, I may say audit procedures. They all mean the same thing. This is information trying to determine whether the assertions are appropriately evaluated within the financial statements. So you'll notice up here, this is our management assertions. When I said audit procedures, these are the tests we perform over these assertions. And these represent specific types of evidence. So evidence is the information used by the auditor arriving at a conclusion about the audit being based. The following concepts of audit evidence are important both the understanding and conduct of the audit. So first of all, we want to understand the nature of audit evidence. Next, we want to make sure the audit evidence is both sufficient and appropriate. And then finally, we need to evaluate the audit evidence to understand the evaluation audit. So what's the difference between all these terms? I'm glad you all asked, because we're going to talk about that. So nature is actually pretty straightforward. Audit evidence generally can have one of two characteristics, okay? The first of these are going to be accounting records, which of course that makes perfect sense. We're accountants, so we want to make sure that we evaluate any documents or records that are generated as part of the accounting process. So I could actually give you a whole bunch of information about accounting records, but basically it's just saying any records that are generated as part of the accounting process within an organization can be evidence for our audit, okay? Now, I'm going to apologize for this next slide because this is kind of a letdown. Okay, so there's an old joke by Mark Twain where he says, "There's only two times you shouldn't gamble: when you don't have the money and when you do." All right. Same thing is going to apply to this particular slide. If we're talking about any types of evidence that can evidence that other than accounting records that we can use, it's basically anything other than accounting records. Okay, so accounting records and things that are not accounting records. Those are the two types of audit evidence. And there's an important distinction because we would probably isolate ourselves to accounting records, but there's a wide world of information that we can obtain that doesn't have to necessarily relate to information. In fact, accounting records is basically going to be compartmentalized into one category of evidence for us, but we have a lot of different opportunities available to us as auditors. So it's important to note that. Next is sufficiency and appropriate audit evidence. So sufficiency is the measure of the quantity of evidence. Now, theoretically speaking, this should not matter, okay? We should say that one piece of audit evidence, if it's good enough, is going to be sufficient enough to prove a point. In reality, the way the real world works, generally, we have to determine a particular amount of evidence that we have to gather to prove our point, okay? It's a little bit like you writing a capstone paper, and you ask Dr. Eisen or Dr. Artero, says, how many pages does it have to be? The assumption being that if it's less than that many pages, that it's not sufficient for the capstone purposes. You could potentially write a really good capstone paper in fewer pages than that, but they're saying that for sufficiency purposes, you have to write that many pages. Same holds true for the theory behind audit, is that we want to make sure that you collect sufficient evidence to prove your point. Which is sufficiency is a measure of quantity, then appropriateness has to be a measure of quality of audit evidence. And audit evidence is considered appropriate when it's both relevant and reliable. The relevance of the audit evidence refers to the relationship to the assertion. We want to make sure that the evidence actually relates to the assertion, because there may be great evidence out there, but if it's not testing the assertion we're concerned about, then it's not particularly relevant to us. We also need to make sure that it's reliable, whether that evidence can be relied upon to signal the true state of an assertion. Evidence with respect to reliability, that tends to be whether or not it's correct, it's false, the type of evidence, and even the timing of the evidence. One of my favorite things to talk about is reliability of evidence is what is the time frame for it? If I ask you for information about the current year and you get me information from 5 years ago, that may be evidence that's relevant, but it's definitely not reliable. Okay, it's not, or I shouldn't say the reliability, actually reliability relevance is switched up. Never mind. Ignore what I just said. Okay, reliability evidence is certainly going to be problematic. One thing that we're going to note with respect to reliability is that's a lot of how we frame our audit evidence. Certain types of evidence are going to be viewed as more reliable than others just by their very nature. When we determine that, we're going to say low reliability evidence is generally evidence we cannot use by itself. Okay. If we identify that certain evidence is low reliability, we may need to gather additional evidence to corroborate that information. Not to say that low reliability tests are not useful, but they generally cannot be used on their own. All right. Final thing is going to be the evaluation of audit evidence, And then proper evaluation audits require the auditor understand the types of evidence that are available and the relative reliability or diagnosticity of the evidence, which diagnosticity, the definition of that is just basically how well the evidence support a given premise versus available alternatives. So this is going to be something that we're going to go into a lot more depth about after the first exam, but the idea being is that we have a conclusion, but there are alternate possibilities that we can evaluate as well. How well does our evidence support the premise that we set versus all available other premises? If the answer is the evidence is pointing in a different direction, we need to conclude that maybe our evidence doesn't support what we believe is to be correct. To that end, an auditor needs to be thorough in searching for evidence and unbiased in its evaluation. So thorough basically implies that we have to gather sufficient appropriate evidence, but the unbiased basically means that we can't actually ignore evidence that doesn't meet what we believe to be correct. This is certainly problematic because auditors do work a lot of hours, and if we get information that's contradictory to what we want to be correct, it may mean more work for us, but that's just part of the job. Okay. So let's go ahead and talk a little bit about something we've already discussed. Remember, we had these slides back from chapter, I don't remember what chapter it was. This is a while back. This is from a slide back, but we talked about the phases in audit testing. And remember when I said phases in audit testing, these are not necessarily just phases in the audit, but these are phases where we can actually gather information about the client, where we can actually gather evidence. And last week, we talked about risk assessment procedures. We went into detail last week and a little bit of the week before that. And then we talked about test of controls taking place after that, and then wrapping up with substantive procedures. So we're going to come back to this slide because what we need to know is the next slide, when we talk about all the different types of evidence, certain types of evidence are going to be relevant to certain procedure areas. So we can only gather certain types of evidence depending on what's going to be relevant during that to that particular phase of the audit. And we'll talk a little bit about why that's the case here in just a second. Okay, here we go. Audit evidence regarding management assertions. So the first one is very easy. This is inspection of records and documents. Remember that the slide when we talked about nature of audit evidence and I said accounting records? So that's effectively where we inspect accounting records, which is pretty easy. Client's going to have accounting records. We're going to review the accounting records. A good chunk of our audit evidence is going to come from this particular type of, our testing is going to come from this type of evidence. So this is very, very useful. It's important to note that when we talk about this particular type of evidence, it's very, very flexible, and it actually provides a decent amount of reliability. It's probably our most powerful overall type of evidence. The reason why is because we can use this in every phase of testing, and it has some reasonable reliability. Now, I'm going to talk to you a little bit about two special types of inspection records and documents. I'm going to talk about vouching and tracing, okay? Vouching is a specific inspection of records and documents test that looks at existence occurrence. And tracing is a specific types of test, special record documents that looks at completeness, okay? Now, you may wonder, how am I supposed to remember that, Dr. Barnes? And this is the fun part. This is where things are going. If you can remember this association, it's going to make things so much easier. Let's see if I've actually got the image here. So I created this fancy image that's going to be just amazing for you guys. But yeah, here we go. All right. This is going to blow your mind, guys. Here we go. Vouching and tracing. Remember I said that existence, occurrence, and completeness were directional tests? You put an arrow down on the vouching, it's pointing down, okay? It's a test of existence occurrence, goes from bottom or from top to bottom. Tracing, it's a test of completeness. We start at the bottom, we move to the top. It's a test of completeness because it's a top or bottom to top test. Top to bottom existence occurrence, bottom to top completeness, yes. Ignore my stutters, yes. But yeah, so if you understand that what the directional assertions are, then you can actually just look at this as a reference. So putting a hat on the T will basically imply that we're moving upward, and tracing test completeness. So that's the direction completeness goes. Vouching the other direction, put an arrow down on the V. Let's go. I wish I could take credit for that, by the way. That's a Becker thing, okay? Even though this is my cool diagram, which you guys have got to be impressed with that, you know. It looks like I took 20 seconds to just fill it in. Probably was a little bit longer because it took me a while. All right, moving forward. Next, we have inspection of tangible assets. Inspection of tangible assets is an extremely potent test. It allows us to look at the assets we're concerned about and gather information about whether they exist. Now, very high reliability test, but you'll notice I used a specific word. I used the word existence there. Inspection of tangible assets only test existence. It tests one assertion and that's it. Moreover, it's usually going to be limited to really large assets because we're not going to be able to inspect every single tangible asset for small stuff like inventory and cash. So we're going to be looking at buildings, equipment, property, plant equipment generally is what it's going to be reserved for. Next, we have observation, and I'm going to pair that with inquiry. Observation is when we actually go into a client and we observe the procedures that are being utilized and are taking place. Inquiry is where we talk to people who are performing the procedures. Observation and inquiry are very, very flexible, okay? And in the fact that they can be used during all the phases of the audit. However, one thing that's problematic with observation and inquiry is that they are very low reliability. These are our two tests that have the lowest reliability. So flexibility is trading off with reliability. So why do we use them? Because we can use them in every scenario. Why are we very, very suspicious about using them? Well, imagine that you're in the middle of an audit and you want to go watch inventory workers do the inventory count. You want them to do the inventory count, but they're secretly committing a fraud and they know that you're watching them. Are they going to behave differently? Probably so. So you said, you know what? I'm going to inquire about what's going on. Hey, can you explain this process to me? Is it possible they could lie to you? Yeah, I know it's hard to believe that people might lie during an audit. Yeah. So observation and inquiry are basically, they can actually be influenced by behavior of the people you're observing or the people you're talking to. So that's why they're low reliability and usually require corroboration. That being said, it's important to note, inspection records and documents, observation and inquiry, these three types of audit evidence are really important in the fact that these three types of evidence can be used at every phase of the audit. can be used during risk assessment, during testing controls, and during substantive procedures. So those three will always come up, and they're important to note. The other ones, confirmation, we talked about. Confirmation is a third-party request. We've got, our client does business with third parties outside the organization. We can talk to them, get information from them. Oh, by the way, I guess I probably should back up. So I did mention that these three can be used at any point during the audit. Inspection of tangible assets can only be utilized during substantive procedures, okay? Confirmation, similarly, can only be utilized as substantive procedures. Now, if you are writing this down, I want you to make a note of this. If you're not writing this down, I want you to make a memory of this. If you forget this and you're not writing it down, I'm going to throw something at you, okay? All right. Confirmation can never, and by the word never, I mean absolutely never, okay? This is an absolute statement, be used as a test of controls. Why am I so emphatic about saying that? Because I always ask a question on at least one of the exams about confirmation being used as a test of controls. And in every single semester I've taught, I've had at least multiple people in every class miss that question. So let me ask you again, how many times can confirmation be used as a test of controls? Never. Good. Okay. Remember that moving forward. I want you to be the first class in the history of all my auditing classes to not miss that question. Okay. So substantive procedure only. Recalculation. Recalculation is, as it sounds, is basically auditor going in and recalculating client information to determine VAA, valuation allocation accuracy. Much like inspection inspection of tangible assets, it is a very potent test. The auditor is performing the test, so we consider it to be very high reliability. However, it only tests one assertion, VAA. Reperformance. Reperformance is another very high test. That's when the auditor performs tasks that the client does. If they get the same results, they have a lot of conclusion that the client is doing the job properly. Reperformance is very heavily used as a test of control, can occasionally be used as a substantive procedure. By the way, recalculation can only be used as a substantive procedure, just so we know. Reperformance is very frequently used as a test of control, but can occasionally can be used as a substantive procedure. Analytical procedures. Analytical procedures, those basically developing an estimate or looking at trends to determine how performance emerges and determining how we test. We've already talked about analytical procedures to one degree because we said it could be used during risk assessment, but it can also be used as a substantive procedure. Specifically, there's a sub-phase called substantive analytical procedures, and there's a follow-up phase at the end of the audit that we can use it at. We're going to talk more about analytical procedures on Wednesday and go into a little bit more depth about them. But for right now, you should know that they are going to be used multiple times during the audit. And two that we're concerned about are during the risk assessment phase and during the substantive procedures. All right. Going back, had the phases in audit testing. So risk assessment procedures. I said there were 4 types of evidence that can be used during here. Does anybody remember what they are? Because I mentioned it last week and then I just mentioned it now. I'll give you a hint. I told you 3 of them were going to be used in every phase. So you should probably know what those are. Inspection records documents, observation, inquiry. And then I said the last one we talked about, I said that we can use that as a preliminary procedure. Analytical procedure, yes, okay. So those 4 types can be of evidence can be collected here. Test of controls. Test of controls, we know 3, inspection records of documents, observation, inquiry. I mentioned 1 is frequently used as a test of control, though it can be used as a substantive procedure. Does anybody remember which one that one was? Reperformance, yes, reperformance. I also want you to write down here, I want you to write down another procedure. It's going to be called walkthroughs. And you're going to say, why is that on our list of evidence, Dr. Barnes? The answer that I'm going to give you right now is that basically a walkthrough is just a combination of all the other tests. So it's basically like a buffet. Okay. The walkthroughs is kind of buffet of all the other food. So we're not going to talk about all different types of food and say there's a 5th type of food, which is a mishmash of all of them. Okay. So walkthrough is just kind of a combination of inspection record documents, observation, inquiry, reperformance. And then we have substantive procedures. We have substantive analytical procedures and substantive tested details. All right. So there's only one type of evidence that can be collected during substantive analytical procedures. Which one do you think it is? Analytical procedures. Very good. Very good. Okay. With respect to the other test of details, we can collect all the types of evidence except one. Can anybody guess which one it is that we don't collect during test of details? Give you a hint. It's this one right here. Analytical procedures. So we perform analytical procedures, and then during test of details, we can perform any other tests that's available to us. Okay. So that's our concluding test work. Now, just so we know, I'm going to move forward real quick. I want to talk a little bit about the spectrum. Okay. We talk about higher reliability tests. So basically, the higher the evidence reliability is going to be dictated by basically how involved the auditor is in collecting the evidence. So inspection of a tangible asset, reports, recalculations, these are things the auditor directly does, the auditor is directly responsible for. We consider them to be high reliability. On the other end of the spectrum, low reliability, those are going to be things that we rely almost exclusively on the client for, observation and inquiry. That's going to be our spectrum for determining reliability. I kind of can clarify, or the book kind of depicts this as being the high types of evidence, the medium types of evidence, the low types of evidence. And I've got a document that's going to clarify that. But I wanted to share what Becker actually says, because Becker actually has a really clever mnemonic. If you ignore the last letter, it's really clever, okay? So their mnemonic is AEIOU, all right? A is auditor-generated evidence. E is external evidence. I is internal evidence. O is oral evidence, which is observation and inquiry. And I hate to say this. The U is you know it. That's how they complete the acronym. Okay. I feel so cheesy saying that. That's actually what it is, legitimately. Okay. Just remember the AEIO, okay? Audited generative evidence, external evidence, internal evidence, oral evidence. It's actually a really good mnemonic for remembering all those things. By the way, all of these things that we just covered about audit evidence, these are going to be relevant to your discussion that's going to occur on Wednesday. All right, this is going to be just relevant to your discussion on Wednesday. So you may be asking, how are we supposed to remember all this? Well, the first answer is you could watch this video again because it's going to be available on YouTube. You can refer to it. But I actually allude to in the assignment. Let's go ahead and see if I can go back to the assignment. Refer to the audit assertions, audit evidence file in content tab on Brightspace. So if you go over here to course materials, you're going to notice that there's a spreadsheet here called audit assertions, audit evidence. And this actually lists out all of the types of evidence we just talked about, the relevant to relative reliability of each type of evidence, and then talks about each assertion that can be tested by the evidence. So if you use this spreadsheet, you'll have all the answers that you need for the discussion. Somehow I always talk about this and still somebody in my class fails to use the spreadsheet, even though this is a very easy resource for it. So I've given you all the answers for the discussion assignment. You just need to use the spreadsheet. And this is going to identify it. Now, it's important to note that this is not probably sufficient by itself because you do actually have to think a little bit about it, like understanding why certain types of evidence are more reliable than others. You will have to discuss that. But for the most part, the answers are pretty much given here for you. So that's going to be a resource for you to note. Okay. So let's talk a little bit about what's happening here with respect to audit testing hierarchy. So we've already talked about the phases in audit, and we've talked about the relationship with respect to risk assessment. But what is actually going on during the later procedures? Well, basically at this point, test of controls and substantive procedures, these are going to be our assertion level tests. Now, during risk assessment, we can test at a very high level. We can test inspection records, documents, observation, inquiry, and preliminary analytical procedures, but we haven't really looked at the individual assertions to test those. Test of controls and substantive procedures. These are the times when we actually look at management's assertions and we make the determination, are these assertions valid through our test work? The first of these is going to be test of controls, which the test of controls is going to be a determination of what are the controls, what assertions do they represent, and how do we go about testing those? So remember back in AIS when I talked about controls, I said controls are a response to a risk, okay? And then we as auditors in this class are saying, all right, we know controls exist. How do we determine if these controls are present and operating effectively? Thus is going to be the focus of controls. We're not going to go into too much depth on that because that's what chapter 6 and 7 are reserved for. But I do want to kind of give you a little bit of insight as to what the next steps are going to be with respect to this area. So you may have noticed the image that's on Brightspace is probably something that I put together, which this is what I call the control sequence. It makes it a little bit easier to understand how controls work. So we identify a risk because, a risk has to be present for a control to be present. Remember earlier I said that the way that we characterize risks in this course are going to be management assertions. If a management assertion is violated, that represents a risk to the organization. Once we identify the risk, then the organization should have a control in response to that risk. And we as auditors, we're going to be testing the controls. So at this point, we're going to be determining, okay, what assertion are we concerned about? What is the risk that's present? What is the control there? And is that control operating effectively? And there's going to be two, I probably should say, there's going to be two things we're going to consider. First of all, is the control there? Is it present? And secondly, if it's present, does it work? So that's kind of what we're moving forward. And again, this is all framed through the context of management assertions. Moving forward, once we've made that determination, we're going to actually assess our final level of control risk. And as we're going to find out, that's going to say, we're going to make a preliminary assessment of control risk that we're going to determine after our testing what control risk actually is. Once control risk is established, then we can establish our detection risk. Now, remember from audit risk model, detection risk is actually going to determine how much work we have to do at the end of the audit. This is actually saying how much work do we have left during substantive procedures. That's detection risk. The first thing we're going to do is we're going to say, all right, can we actually capture any what I like to call low-hanging fruit? I know that's an idiom, which I try to avoid them in this course, but we're going to try to say, can we easily test certain accounts by using estimates? And that's going to be substantive analytical procedures. An example I gave you in this course is, could anybody in this course actually give me an estimate for what depreciation should be for financial statements? Well, the question is that has anybody ever calculated depreciation before? Hopefully you all have, back in 221. Again, if I give you all the details of the information, if I give you the values of the assets, if I give you the residual values, the number of years of their useful life, the depreciation method, everybody should be able to make calculations and make an estimate for what depreciation is. Can we compare that estimate to what the actual amount is? Hopefully so, okay? So that would be an area that we could utilize substantive analytical procedures for testing. We get some level of assurance from that, and then we say, how much more assurance do we need? How much information do we need to say the financial statements are either free from misstatement or materially misstated? We got to gather whatever remaining evidence we have, and that's basically substantive tested details. The way to think about substantive tested details is that is our last shot to gather information. We've tested controls, we've performed analytical procedures. Whatever we have left that we need, we gather during this final phase here, or kind of this wrap-up phase. It's not really our final phase. We got more phases after that, but our final assertion testing phase. How is this relevant? What is the whole purpose of going into this procedure? Well, the way the book characterizes it is it's called this idea of the assurance bucket. So they're going to say there's going to be multiple phases that you gather evidence, which are going to be the idea, these areas that we talked about before. So controls testing, substantive analytical procedures, tested controls. They even consider risk assessment to be part of that. But at every point that you collect evidence, you gather a little bit of assurance, okay? Every point that you gain information, you get a little bit more confident about what the true direction of an assertion is, whether it's correct or not. And they say you're basically filling a bucket up every single time you you go through a phase. So the first phase, you fill the first bucket up is risk assessment, then tested controls, then substantive analytical procedures, and then whatever remaining is left, that's what you have to fill through substantive tested details. Now you can kind of think about this logically speaking, is that you can say, well, if I gain less assurance down here during these phases, that means I have to gain more assurance up here at the end. In other words, if you gain less assurance early on, you have to gain more assurance later, which means more work later. That was the idea behind wanting to have good controls. Good controls mean more assurance. More assurance means less work later on. So that's kind of the idea the book says. Now, here's the deal, guys. I am not a boring person. At least I try not to be. I'm actually a very boring person, but I try not to be in class, okay? I think this analogy is fine, but it's not very exciting, okay? So I want to propose to you an alternate analogy, okay? This is my Chipotle burrito analogy. Now, I don't know how many of your fans are Chipotle. It's interesting. When I was actually living in Dallas and had full access to Chipotle all the time, same thing when I was living in Stillwater, I didn't take as much advantage as I should. And it's like that song, you don't know what you got till it's gone, because I really would like to have like a build your own burrito place here in Kirksville. Don't get me wrong, the Tex-Mex restaurants that are here in Kirksville are fine, but I would just, some days I just kind of want to say, I really want to build my own burrito, but I don't want to build my own burrito. I want somebody to do it for me. All right. So going to Chipotle, okay, you say you're going to order the burrito. What is the very first thing they do when they make your burrito? They pour it out and they put what on it? Yeah, roughly a metric ton of rice. Okay. And then they say, what would you like on your burrito? And you say, well, I didn't want that much rice, but you're polite. You kind of keep it to yourself. Say, I'd like chicken. I'd like pico de gallo. I'd like sour cream, guacamole, some cheese. And so they put like a tablespoon of each of those on there. Okay. Then they wrap this monstrosity up together that's like 99.9% rice. Okay. And they hand it to you. It says, enjoy your burrito. And you're wondering why prices go up. Why do they put rice on there? It's because they want to keep the prices low. Because if they fill it with rice, they don't actually have to put a whole bunch of the good stuff on there. Okay. So from our perspective, we're just kind of like, well, that sucks. But from their perspective, that's great. That's them getting assurance during those tested controls, getting assurance early on. They don't have to put more stuff on later on. So they're actually saving money by not giving you all the good stuff. But you're savvy. You're just kind of like, okay, you know what? I'm not buying this rice thing. Rice is fine in some things, but rice is not what I want in my burrito. You don't want a burrito, I want chicken, and then more chicken. And I want guacamole, and then more chicken after that. And then a whole bunch of cheese. Okay. So you basically say no rice, and they will stare at you with daggers in their eyes. Okay. And then they will give you chicken, and they will give you guacamole, and then maybe you want steak because you want to mix it up, and then you give some cheddar, and then you put like on all that stuff on there, and you get all the good stuff. Okay. If there's no rice on there, you have to fill it up with really good stuff. That's filling the burrito up with the stuff during the end. And that's the analogy. It's like if they can't fill it up with the early stuff, they have to fill it up with more of the late stuff. If in the audit, if we can't get all of our assurance from tested controls or get most of our assurance from tested controls and for substantial procedures, then we've got to get more work done later on. So from the burrito perspective, we're really like, yeah, gung ho, it's like more chicken. But from the audit perspective, we're like, man, I really wish there was more rice because that rice means that we do less work later on. That's kind of the analogy. So keep that in mind, is that ultimately what we're trying to go is we're trying to get that full burrito. And whether that means that we're going to be putting rice in it, or we're going to have to actually put the work in and put the chicken and the queso and the pico in there. Ultimately, a full burrito is our ultimate goal, a full audit burrito. That's what we're trying to get to. All right. I think that does it. So we're back on Wednesday. We've got our discussion. Please make sure you prepare for the discussion and answer all the questions, and I will see you all then.